So first of all, we can't forecast where markets are going, or economies for that matter, in the short run. So what we try to look at is what is the balance of evidence given economic data, how that data flows through into economic profits, and then those profits are reflected through a higher valuation of companies in the stock market. So when we're taking a look at 2019, right now the economic data, although still positive, is definitely slowing somewhat from rates of 2016, 2017, 2018. That said, they still remain positive. And what we focus on, as opposed to trying to forecast where markets are trying to get to, is what are individual companies producing in terms of economic profit, because that's how you value any business. Any institution's value is determined by the profits it generates, and then that is reflected in the stock market. Profits in 2018 grew at north of 20% that year, largely on the back of the tax abatement programs that the president implemented early in the year. So we had very robust corporate profit growth. That growth is slowing for sure. It's not sustainable at that rate into 2019. That being said, we would expect corporate profits to grow somewhere around, mid single digits, which is still very, very healthy and could provide valuation support for the stock market going forward. So first off, 70% of the time on a calendar year basis, the stock market produces a positive rate of return. So that's a pretty good odds in your favor right there. What we know is that profits drive price, because the value of any business is determined by the profits it generates. So if you take a look at a chart, what you'll notice that the correlation between profits on the S&P 500 and the movement of the S&P 500 are very, very highly correlated. In other words, they move together. So that's what we focus on. Interestingly enough, in 1998, 1999, we had an event called the tech bubble, and it shows up very predominantly on the corporate profit chart, where the earnings are increasing, but the market leaves that earnings line and moves well north. And then it collapses, and it collapses back to the earnings line because technology stocks, which were the asset of choice at that time, produced no economic profit. So the idea was that technology had repealed the basic law of finance that profits are how you value a business, but it didn't last very long, and it collapsed right back to the earnings line. So that's what we look at. We very much are focused on corporate profit and corporate profit growth. So 2019, what we'll be looking at is the economic data. We'll be following that very, very closely. But there's also macroeconomic things that we have to be very, very mindful of. Recent concerns around recession risks that we've already mentioned. Certainly trade wars with China in particular, and how those manifest themselves over the course of the year. And Fed policy. In terms of wild cards, by definition, they're not forecastable. So you always have to be very, very aware of things that were not expected and how they can affect not only markets, but certainly global economic activity. So they're out there, we just don't know what they are right now. Build a globally diversified portfolio, and based on your individual ability to accept risks, certainly, and then allow it to work. But one of the critical elements is to get advice on rebalancing, making sure that your positioning is consistent with your risk profile over time, because asset prices are fluid. So your weightings in various asset classes are changing all the time. So the need to go back, monitor it, at least on an annual basis. Take a look at the positioning relative to your risk profile and make sure that they're both consistent is very, very important.